Hey everyone, welcome to episode 2 of Table Talk with Mike. And today I thought we would take on a hot button topic that's going around right now, which is interest rates. If you've been following the news at all, if you have any borrowing at all, you're probably well aware that the interest rates have been increasing for the last 6 to 8 months and forecasted to increase further going into the near future through the end of the year for sure, based on the Bank of Canada here in Canada and the Federal Reserve down in the US trying to rein in inflation. So there's a lot of different ways, a lot of different things that go into what causes interest rates to go up or down. And while I have a major from university in economics, I'm not an economist, and I'm not going to delve into all of those details today. But what I thought I would talk about today is whether or not a fixed rate or a floating rate is right for you, and how you can determine that. Let me give you some ideas as to how to figure that out and what's best for you. Now, when you look at interest rates, a fixed rate is fairly self-explanatory. It's a fixed rate for a set period of time. So if your amortization, say on a residential mortgage, is 25 years, you typically will have a term of anywhere from 1 to 5 years. And say you choose a 5-year term, fixed rate, you know exactly what your rate will be for that 5 years. It doesn't matter what rates do. They could go up or down, but your rate stays the same during that time. And that gives you a fixed payment. You know exactly what your payment's going to be for that period of time as well. So if you're on a budget and you need to know exactly what your payments are going to be for 5 years, that's a good way to go. Now, a floating rate, or a variable rate, as it may also be called, there are a couple different things to consider there. So most variable rate loans or mortgages will have a fixed payment amount, so similar to a fixed rate term. However, the difference being, in a variable rate with a fixed payment amount, if the prime rate goes up, the amount of your payment that goes to paying the principal will decrease, and the amount of interest will increase that you're paying on that particular monthly payment. So the issue with that one is, at the end of your term, if rates have increased, the amount of principal reduction may not align with having your loan paid out within the agreed upon amortization period. So you could end up seeing, as you renew your loan, your mortgage, a big increase in your pay, in your payment, to make up the difference and make sure that the loan or mortgage pays out within the agreed upon amortization period. So that's one way to look at a variable rate mortgage. The other option on a variable rate term loan or mortgage is an adjustable rate, where it's a fixed payment again. However, if the interest rate increases, your payment will increase. So over a course of a 5-year period, in today's market, with rates increasing the way they have, what you were paying on your monthly payments a year ago would be much higher today, based on the fact that the interest rates have increased as much as they have. So those are kind of some details on the different types of rates and what they mean and how that impacts your monthly payment going forward. So how do you determine whether or not a fixed rate or floating rate is best for you? One of the things that I kind of put together when I was a mortgage broker years and years ago to help my clients figure that out was to understand their level of risk tolerance. So, for example, if it was a $500,000 mortgage, how do you determine which is the best way to go? Well, think of it in terms of, you have that 500,000 and you're going to invest it. So it's not a mortgage, it's not debt. You actually have that money in hand and you're going to invest it in some kind of a stock market or a mutual fund or whatever it might be. How much risk are you willing to take on? If you're fairly conservative and you don't like risk, you're happy with a smaller return on your investment, then a fixed rate might be the best way to go. If you're somewhat of a risk taker, even calculated risk taker, and you're okay with a little bit more risk, with the potential of having a bigger return at the end of the day, then floating rate might be the way to go. Historically speaking, floating rates over the course of the last 50 to 60 years have proven to show a lower amount of interest paid over the course of repaying your loan or your mortgage. So for some of us, myself included, I am in a floating rate mortgage and I'm going to stay there. It could be the better way to go, because over the course of the 25-year mortgage, you're paying less interest. However, it's up to you as to how you feel and how comfortable you are with that. So, historically, you're looking at a prime rate today of 4.7%, but historically, as recently as 2007, the prime rate was 6.25%. And the long-term average over the last 50 to 60 years has been more in the range of 7.2%. So when you look at it in those terms, we are still in a lower rate environment than what historically has been out there. So it may not feel like it, but historically that's what the numbers show. So hopefully that helps and gives you some ideas as to which way to go if you're looking at converting out of floating rate into a fixed rate, or if you're taking on new debt now and want to know what might be best for you. If you have any questions, certainly leave a comment or send me a private message, and be happy to talk more about that.